The biggest wealth shift in 82 years has just begun, and most people are going to miss it completely. Not because the information's hidden, not because you need some kind of special access or insider knowledge, but because the shift is happening gradually and then all at once. And by the time most people notice it, the best opportunities will already be gone. So let me walk you through exactly what is happening right now, beyond the surface of the global financial system, why it matters more than anything else you'll read or watch this year, and what you can actually do about it before the window closes. Because here's the reality. The people who understand this shift are going to grow their wealth faster than any previous generation. And the people who do not are going to slowly fall behind while wondering why their accounts are not keeping up with the cost of living, even though they did everything they were told to do. Let's start at the very foundation, because to understand where we're going, you have to understand how we got here, why the system that created so much wealth for previous generations is no longer working the way it used to. 82 years ago, 1944, at Bretton Woods Conference in the US, the dollar was formally designated as the world's reserve currency, and that single decision shaped the entire architecture of global finance for the next 8 decades. And it's the reason that for generations, the investment playbook was so simple it could fit on a napkin. Great skiing at Bretton Woods. So buy American stocks, hold them forever, let the machine work. That was it. That was the whole strategy, and it worked beautifully, because the entire global financial system was structurally engineered to funnel money into the US. Every petrodollar spent on oil flowed back into dollar-denominated assets. Every foreign government and central bank holding reserves did so primarily in dollars. Every international investor looking for a safe place to store wealth defaulted to US stocks, US bonds, and US real estate. The demand was constant, the demand was global, and it drove American asset prices higher decade after decade after decade. But to understand why that system is now breaking down, you need to understand what made it work in the first place. The dollar is not backed by gold. It's not backed by silver. It's not backed by any physical commodity. It costs 12 cents to print a $100 bill. The reason the dollar has value is purely because the entire world chose to believe it had value. That collective faith gave the US something extraordinary, something no other country in all of human history has ever possessed. The ability to run up debt on a scale that would destroy any other economy on earth and keep going. Because when you're the world reserve currency and the whole world has faith in your money, you can borrow and print in ways that other countries simply cannot. And the US used that privilege aggressively. The federal government currently carries over $38 trillion in national debt. Let that number sit for a moment, $38 trillion. And the way that debt gets financed is through a loop that feeds on itself endlessly. The government collects taxes, it spends all those taxes, and then some, because it never feels like it's enough. Then it has to borrow the difference. It borrows from regular people through savings bonds and treasury bills. It borrows from institutions and big banks. It borrows from foreign governments like Japan, the United Kingdom, and China. And when none of that's enough, which it increasingly has not been, it turns to the Federal Reserve, which, despite the name, is not actually a federal agency. It's not actually sitting on any reserves. And it's not actually a traditional bank in any meaningful sense, but does have one unique and extraordinary power. It can create money from nothing. New dollars get created out of thin air, lent to the government, and spent into the economy, and that has a consequence, because if you could just print an unlimited amount of money, why would anyone need to pay taxes at all? The consequence is inflation. The prices of everything going up, every dollar printed through that process is a quiet, invisible tax on every dollar you already hold. Your savings lose purchasing power, your paycheck buys less, your retirement account grows nominally, but the things you need to actually live keep getting more expensive faster than your account can keep up. And here's the number that should make every American stop and pay attention. The second largest expense in the entire federal budget is not defense spending, it's not healthcare, it's not Social Security. It's paying interest on the national debt. More of your tax dollars go towards interest payments on money the government already borrowed than go toward funding the entire US military. And that number keeps growing because the debt keeps growing. The interest payments keep compounding on top of themselves. Now, for 82 years, the world looked at all that and kept the faith. Countries kept lending to the US, investors kept storing their wealth in dollars. Global trade kept happening in dollars, and that faith kept the whole thing running, because when the whole world believes in something deeply enough, it can sustain itself well past the point where pure logic would suggest it should have collapsed. But faith is not permanent. We're now watching in real time as that faith begins to erode in ways that have never happened before in the post-war era. Here's the clearest signal that something has fundamentally changed. Back in 2001, 74% of all global reserve currencies were held in US dollars. By 2025, that number had fallen to approximately 49%. That's a 25 percentage point collapse in global confidence in the dollar as a reserve currency over just 2 decades, and the trend is still moving in the same direction right now. Countries are not just holding fewer dollars, they're actively and deliberately building alternatives to dollar dependence. The BRICS nations, which include Brazil, Russia, India, China, South Africa, are working to create trade alliances that allow them to transact in their own currencies entirely outside the dollar system. For the first time in the entire post-war era, we're starting to see oil, the single most strategically important commodity in the global economy, being priced and traded in currencies other than the dollar. And central banks around the world have been on a sustained and increasingly aggressive campaign to accumulate physical gold. Not paper gold, not ETFs, physical gold bars that they can hold in their own vaults and use to back their own currencies, independent of anything the US does or says. Now, let's talk about gold specifically, because gold is one of the most important signals of what sophisticated money is actually thinking about the future of the dollar. Gold doesn't have employees, it doesn't generate revenue, it doesn't build products or expand into new markets or report quarterly earnings. When you buy gold, it just sits there. So when people buy gold aggressively, when institutions buy it, when governments buy it, when the price keeps climbing year after year, the reason is never because gold has become fundamentally more valuable in any productive sense. The reason's always fear. Fear about the dollar, fear about inflation, fear about the stability of the financial system, fear about what happens when the music stops. And right now, the biggest buyers of gold on earth are not retail investors picking up a few coins. They're central banks, national governments. The very institutions that are supposed to have the most faith in the existing system are the ones buying gold the fastest because they're preparing for a world where the dollar is not the unquestioned foundation of global finance. Gold is up 21% year to date as of early March 2026. And here's the thing most people don't know. We're only 2 years into what historically has been a 4.5-year average gold bull market. We're not even halfway through. The central bank demand is still rising. The dollar is still weakening. Interest rates are on hold because of a combination of war and persistent inflation. And the single catalyst that could send gold truly explosive has not even happened yet. The actual sovereign debt reckoning, the real confrontation with $38 trillion in obligations. There's been no genuine fallout from the debt. Everybody's been talking about it for decades. There was a book written about it in the 90s. People were warning about it in the 80s. And yet, here we are, and the market's never truly been forced to price in what happens when the world stops rolling over that debt at reasonable rates. When that moment comes, and the evidence suggests it's getting closer, not further, that will be the biggest move in the history of gold. But we don't need to wait for a catastrophic debt crisis to understand that the old investment playbook is broken, and the new one requires you to think very differently about where wealth is being created and preserved right now. Look at what's happening to global investment flows, because this is perhaps the most concrete and measurable evidence of the shift we're describing. In 2022, 92 out of every $100 flowing into global stock markets went into US stocks. By 2026, that number has collapsed to just $26 out of every 100. 74 cents of every dollar that's flowing into global equities is now going somewhere other than the US. It's going to Asia, into Europe, into emerging markets that are growing faster than the US and trading at valuations that are far more attractive than a domestic stock market that's become dangerously concentrated. The 7 largest companies in the S&P 500 now account for more than a third of the entire index. That means when you buy a broad index fund today, you're not actually buying a diversified slice of the American economy. You're making a heavily concentrated bet on 7 mega cap technology companies. And while those companies are extraordinary businesses, the concentration itself is a risk that most investors are not fully accounting for. Meanwhile, the rest of the world's been quietly catching up and in many cases surpassing US growth rates. New investment opportunities are emerging in markets that simply did not exist in any meaningful way 10 or 20 years ago. And global capital is flowing toward them at a pace that's rewriting the rules of portfolio construction in real time. You can already see it in the performance numbers. Energy's up 26% year to date. Gold's up 20%. Silver's up 15%. Materials up 14%. Industrial's up 12.5%. Those are the sectors that are leading right now. Meanwhile, the S&P 500, flat to negative for the year. The Nasdaq's down nearly 3%. Consumer discretionary is down. Technology, of course, down. Financial services down. Rotation's not a theory about what might happen someday. It's happening right now in real time, and It's been happening all year. Now, let's talk about the current moment, because the military conflict in the Middle East and everything that's unfolded over the past week, it's not just a geopolitical event to watch on the news, it's an acceleration. Every single trend we've been discussing is moving faster. It's getting triggered. The exact same government response that's been triggered by every single major crisis in modern American history is happening now. On February 28th, the U.S. launched major combat operations against Iran. Oil prices surged immediately. The Strait of Hormuz, which is the narrow waterway that funnels roughly 20% of the world's entire oil supply, effectively shut down as tanker traffic stalled under the threat of Iranian retaliation. Iran hit back with missile and drone strikes targeting the UAE, Kuwait, and other Gulf nations. U.S. embassies closed, shipping routes went dark, and Wall Street immediately started asking the only question it ever asked during a crisis: when's the bailout coming? Because Wall Street's learned from experience that the bailout always comes, and Uncle Sam's not disappointing. February 5th, the Treasury Department announced that the Federal Reserve had already pumped $90 billion into the financial system to stabilize markets, and signaled clearly that there's no plans to slow down. That was in the beginning of February. And this is the same playbook that's been run every single time without exception. In 2008, when the global financial system was on the brink of total collapse, the government created a $700 billion emergency bailout fund through TARP. The Federal Reserve launched quantitative easing for the first time in U.S. history, buying up mortgage-backed securities and treasuries by the trillions. The Fed's balance sheet, which had been roughly $900 billion for decades, exploded to over $2 trillion, almost overnight. Then COVID hit in 2020. The economy locked down. The government printed $5 trillion. The Fed's balance sheet went from $4 trillion to nearly $9 trillion in just 2 years. Congress passed a stimulus check after stimulus check. The Fed dropped rates to zero, bought anything that moved. The S&P 500, which crashed 30% in March of 2020, was at an all-time high by August, just 4 months later, and kept going for another 2 years. Look even further back, World War II, the U.S. ran deficits of up to 30% of GDP to fund the war effort. The Federal Reserve was formally subordinated to the Treasury, holding rates artificially low, while the government printed money to finance the fight. Vietnam produced more deficit spending and more money creation, which fed directly into the crippling inflation crisis of the 1970s. The Gulf War in 1991 triggered emergency liquidity measures. The Iraq War in 2003 launched alongside the largest rate-cutting cycle the Fed had ever run in 20 years. The pattern's always exactly the same. Crisis hits, markets wobble, governments print. Wall Street, that bought the dip, makes out like bandits. Everyday people who were told to sell because the sky was falling end up holding devalued cash, while the people who understand the game bought assets at the bottom and wrote them back up. This isn't like some great conspiracy theory. It's just history repeated over and over again, across almost a century of foreign and domestic crisis. Every time it's the same, and the trend's even more pronounced right now. In response to the Iran conflict, the U.S. government's deployed 3 separate tools to prop up the financial system. Tool number 1 is government risk absorption. The U.S. Development Finance Corporation has been directed to provide political risk insurance and guarantees for all maritime trade through the Gulf, with U.S. Navy escorts through the Strait of Hormuz if necessary. When private capital will not move, the government steps in, absorbs the risk onto its own balance sheet, and the market stabilizes. We've seen this exact mechanism before: FDIC, deposit insurance, TARP, the Fed's emergency lending facilities in 2020. Same tool, different crisis. Tool number 2 is the $140 billion in consumer spending stimulus that's already in the pipeline from legislation passed in 2025 and timed to hit the economy in the second quarter of this year. Right as war is threatening to crater consumer confidence, there's a $140 billion in government manufactured demand queued up to offset it. The government's creating demand that the private market is not generating on its own. Tool number 3 is information management and sentiment control. Strategic peace signal leaks designed to prevent panic selling before it becomes self-fulfilling. When news hit that Iran had indirectly approached the U.S. to begin ceasefire negotiations, the NASDAQ shot up 1.4% in minutes. The S&P gained nearly 1%. Whether those signals are genuine or they're carefully timed communications designed to buy stability while capital injections take effect, the result's the same. Markets stabilize, panic is contained, and the liquidity has time to work. Now here's where the macro picture becomes especially important, because the Iran conflict has created a very specific dynamic that almost guarantees more fiscal stimulus, not less. Wholesale inflation, the PPI, was already running at 3.6% year over year before any of this started. Now you have an energy shock being layered on top of that. Former Treasury Secretary Janet Yellen said it plainly: the Iran situation puts the Fed even more on hold, even more reluctant to cut rates. Future markets have essentially priced out any rate cuts before September, but history tells us very clearly what happens when the monetary printer becomes unavailable. The fiscal printer starts running on overdrive when the Fed cannot ease politicians, compensate with spending, stimulus checks, infrastructure, bills, defense contracts, tax cuts, war spending. It all flows in the same direction, into the economy, inflating asset prices, and ultimately into corporate earnings. And the US is currently in an active war during an election cycle with an administration that's deeply motivated to keep the economy looking strong. So the money printer is not going to slow down. It's going to accelerate. And every dollar that gets printed flows somewhere. It doesn't evaporate. It flows into assets, into real estate, into stocks, into commodities, into gold, into the sectors that benefit from inflation and from the rotation away from dollar dependence. This is why every major war, stocks recovered. This is why after every major crisis, the people who owned assets came out ahead and the people who held cash came out behind. Carson Group analyzed 40 major geopolitical events over 85 years and found the S&P 500 averaged a 3.4% gain in the 6 months following those events. The bigger the crisis, the more money that gets printed and the more upside there is for the people who are positioned in the right assets when the dust settles. Now, the financial media will tell you the exact opposite. They'll tell you that anytime there's uncertainty, you need to sell. Sell first, ask questions second. And then their friends go and buy the dip. And by the time all your questions are answered and the uncertainty is cleared, stocks have already recovered 30, 40, sometimes 50%, and you missed it. That's the game that's been played for a decade. And after crisis, my job is to make sure you don't fall for it again. The US is still the largest economy in the world. Nothing we're discussing here changes that, but for the first time in 82 years, it's no longer the only real investment opportunity in town. The dollar is no longer the unquestioned foundation of global finance that it once was. Global capital is rotating towards hard assets, toward international markets, toward energy and defense, and the infrastructure of a new financial system that's being built in real time. And the investors who build portfolios that reflect the world as it actually is in 2026, rather than the world as it was in 1990, are the ones who are going to build and preserve real wealth through this transition. The people who don't are going to sit in a portfolio built for a world that no longer exists, while the cost of living continues to outpace everything they saved and wonder why it feels like they're running in place no matter how hard they work. The US is carrying more than $38 trillion in debt, and by every historical precedent, the current system should already be under extreme stress. Yet, financial markets keep hitting all-time highs while the real economy keeps deteriorating. And that gap is being held open by money printing, which means it keeps getting filled in one direction, into assets, into the sectors that benefit from inflation, from the global rotation that's already underway. Remember, energy up 26%, gold up 20%, silver up 15%, materials up 14%, industrials up 12%. These are not random numbers. These are the fingerprints of a major macro rotation that's already in progress, and the investors who recognize it and position around it are going to look back on this moment as one of the most important decisions they ever made. That's exactly where GFS comes in, Global Foundries, because the macro environment is shifting faster than any point in the last 8 decades, and the stocks and sectors that are leading right now are not the ones that dominated the last decade. And knowing which ones to own, which ones to avoid, and when to make your moves is the difference between growing your wealth through this transition and watching it erode while you wait for a world that's not coming back. With that in mind, I've developed a list of the best 6 stocks to own in 2026 that you can download completely free right now at stockscommunity.com/free. These are the specific names that are positioned to benefit from everything we just talked about. And you can have the full list in your hands in the next 2 minutes at no cost whatsoever. And if you're actively managing your own stock portfolio and you want to talk through your specific situation, head over to stockscommunity.com/freedom to book your free 15-minute strategy call with me, where you can dig into your portfolio, your goals, and how to position yourself for what's coming. I'm currently offering this completely free 15-minute training as well on how I personally spot stocks before they go up, and I'll make you an offer at the end of the call to join the community if I think we're a good fit. This is the Complete Stocks community, and one of our recent members went on to make thousands of dollars in a single day just from learning these strategies. You can book this 100% free call right now at the link in the description below. And if you want to see what the inside of my 6-figure strategy calls actually look like, click that link, the second link in the description, for a rare inside look at my one-to-one stock coaching. I have daily calls like this with beginner, intermediate, and advanced investors who just ask me questions specifically about stocks. If you click that second link, you'll get a taste of exactly what that looks like. If you go to stockscommunity.com/training, you'll get my free private 10-minute training called Former Engineer Shares 3 Key Lessons from His Ivy League Experience, along with my 3-step Sunday training protocol. So what did I miss here? What would you push back on? Let me know in the comments below. If you're managing your portfolio independently, take a look at Global Foundries right now. If you want to know how I spot stocks before they go up, head over to stockscommunity.com/freedom for an unfiltered conversation. If I think we're a good fit after the call, I'll extend an invitation to join my community. And you can ask anything for the course of those 10 to 15 minutes. That link, first link in the description below. Global Foundries is at an important inflection point right now. Software is bouncing slightly. I think this particular name, this chip fab name, is a better bet than software, which is already slightly extended. If you like this idea, you like these videos, hit that like button, subscribe to the channel, and share this with somebody who needs to hear it. Thank you for watching, and I'll see you in the next one.